more on this market, let's bring in Charles Schwab's Liz Ann Saunders and Wells Fargo Investment Institute's Darrell Cronk. And I believe you guys are both kind of leaning bearish, right, Darrell, as far as the outlook for next year?
Yeah, well, I would say for the first half of the year, it's kind of a tale of two halves, if you will. The first half's still going to be choppy and rough. You're correct. I mean, all signs point to whether it's 72 basis points for 210s inversion or the LEI as leading economic indicators turning negative. You know, what's interesting on the equity markets in the discussion you were just having is, you know, the U.S. dollar peaked 11 weeks ago. Rates peaked 6 to 7 weeks ago. Those should have been supportive to equities, and in fact, they haven't been, right? And it's particularly long duration equities like tech and growth and everything else, and they've only continued to move lower. So right now, the risk-reward trade-off doesn't look to us compelling yet. If we drop into the kind of 35 to 3,700 range on the S&P, I think that starts to flip a little bit and it becomes much more compelling. But as we stand today, we're sitting right on the 50-day moving average, and all three, 220 and 50, are tightening up like a coiled spring, which history tells us when that happens, you tend to break one way or the other, either the upside or the downside. We think it's more likely the downside.
Everyone was talking about that 3,900 level yesterday as a technical support level. We closed below it. I guess if we close below it again, according to Matt Maley, who's a technical analyst at Miller Tabak, that's not a great sign. Liz Ann, what about you? Where are you leaning toward in 2023? What's the strategy?
Well, one thing that's funny about these outlooks that we all write is it forces you to think in calendar year terms. But of course, neither the market cycle or the economic cycle cares about the calendar. But when you have to frame it in those terms, I would say, you know, what we put in our outlook was in agreement with Darrell. And it's not so much first half, second half. Again, the cycle doesn't care about the calendar. But I think the medicine still needs to be taken. And by that, it's weaker economy, weaker labor market, very clearly shared by the Fed as a most likely, serious, and necessary ingredient in the recipe to get inflation down. Therefore, I think sooner rather than later is the better time to take the medicine, because it does set the stage for maybe not a pivot, but at least a pause for the Fed to reassess. So I think there's still more downside in terms of earnings estimates. There's still more weakness to come in the labor market. We're starting to see some of those cracks. But I think from a market perspective, we're better served to have it happen sooner, not later.
Yeah. Do you think that will actually happen?
Well, when you look at things like the regional PMIs, the S&P Global PMI that came out today, retail sales, industrial production that was weaker than expected, you are starting to see some of those dominoes falter. You may continue to see a bit more resilience in the labor market, at least if you look at metrics like the unemployment rate. But even within the labor market, whether it's hiring freezes, whether it's layoff announcements, which in the Challenger Great Christmas data are up more than 400% year over year, even higher for the tech space. The differential between the household survey and the establishment survey that generates payroll. So you already are starting to see some weakness. It may not manifest itself in a serious uptick in the unemployment rate because of the labor shortage, but I think more weakness is coming.
Darrell, talk us through the earnings expectations for the next few quarters, because what I hear is that fourth quarter should be fine, but it's the outlook for the first quarter, which should be very muddy and uncertain, because just nobody knows what the economy is going to look like and what the Fed is going to do. So where are expectations versus where you think they're going to be?
Yeah, I think fourth quarter will be fine. The interesting thing is, you know, what's beaten earnings has been revenue growth. But if you unpack revenue growth, it's not in unit demand. It's just in price increases, which is, you know, pari passu or on par with inflation, right? So it's the companies raising prices and not, you know, underlying demand.